how much earnings drive stock movements, up, down, or flat? We've talked a lot about earnings being the closest thing to a zero-sum game. They're an engagement tool. Sometimes you have a directional bent, so you make a bet. Sometimes you just want to play the premium collapse. All those are cool. But as a trade, because they happen so quick and because it's just like kind of an overnight vol crush, instant gratification, there's not really a lot of adjusting. There's not a lot of edge. But let's see, how much do earnings drive stock movements? Let's take a little look here. So today we're going to spotlight price dynamics following earnings announcements, analyzing mean percentage stock moves to identify reversals, stability, and spikes. And it's not just about the numbers. We're going to provide insight into market sentiment and reactions. This is going to be helpful regardless of where you are in your trading cycle, whether you're a newcomer or a seasoned pro. We question whether these figures predict future trends or merely statistical noise. What do you think, Pat? Statistical noise, or is there something?
I'm going to say noise. That's just my gut feeling. I obviously have no idea. I mean, you looked at the earnings from Kai just a moment ago, and they've been flat to lower. I don't think there's anything to this myself, but I don't know. What do you think?
I agree with you. I think it's a lot of statistical, more noise than it is, outside of 1 or 2 days. I don't think there's any kind of predictable trend from that. So we used 6 years of research and we picked like 5 of the biggest stocks: Apple, Tesla, Netflix, Amazon, and Nvidia. We calculated the mean percentage if the price will reverse, stay the same, or increase after earnings. We also calculated the magnitude of the change. And we compared results in earnings periods. Remember, in the US, earnings are quarterly. Different places around the world, earnings are different. Like in the UK, for example, they're only twice a year. But quarterly here puts a lot of pressure on companies, to hit their number, I guess. It's the easiest way to say it, or to beat expectations. So for starters, we looked at, again, 6 years, 5 different stocks. And these are, now let's put a little background around this. The last 6 years have been a bull market.
That's correct.
And we picked 6 of the strongest stocks. I mean, Nvidia is a $3 trillion company. Tesla is probably a little less than $1 trillion. Amazon is, is Amazon a $3 trillion company? It's got to be close. Netflix
is. I was going to say it's going to be close.
It's a $2 trillion. Apple is, I think Apple, Microsoft, and Nvidia are $3 trillion. Amazon and Google are $2 trillion. And
Amazon's $2 trillion.
Yeah.
$2 trillion a change.
Yeah. And Netflix and Tesla are just under $1 trillion, but these are huge companies. So
yes,
moves upward across the board. They average about 67%. That's pretty damn good for these companies.
You're going to be surprised. Netflix only $323 billion.
Yeah, I am surprised. I thought it was more than that. But this is the average move after an earnings announcement. So up moves 67% of the time. Reversals after that 33% of the time. And the magnitude of the change, because Nvidia has been so much and so is Tesla, it's about 11%, which I promise you there's not 11%, a lot of 11% expected moves. So what's weird about this number is it skews the things a little bit, because you'd look at Apple, Netflix, and Amazon, you go, oh, those are definitely tradable. But when you don't know what's going to do, which stock's going to do what, and who's going to do this and that. And when you throw in Amazon, when you throw in Tesla and Nvidia, that 11% number, that's a high number. Sure. Like, it's rare to get 11% implied move. Very rare. Like, I mean, you might see it tonight in pound. What's the Palantir tonight? But you're not going to get it for one of these stocks. That's for sure. Right. I think Apple last time was a 5 or 6% implied move. Palantir is probably around 10, 11, 12, isn't it?
It is. Yeah, it's over 10%. Yep.
Yeah, I was going to say it probably is. But for these big stocks, that's pretty rare. That was the first day. So now the second day, let's talk about, in this case, a little bit of continuation. The chances of an up move second day after 67% of the first day, 64% of the second day. And the chance of reversal go up a little bit from 33 to 36. But the magnitude of the change on the second day was surprisingly, on a percentage basis, even greater. So
yeah, it is surprising.
So then we looked at day 3 to say, you know what, is this, is an up move is it that much, that much pressure to the upside? The numbers on day 1, day 2, day 3 were very similar. the magnitude of the change, obviously that continued to, and I shouldn't say obviously, but that continued to go higher. The reversal numbers are about the same. The move upwards about the same. We start to look at these stocks, you're like, okay, that's for the first 3 days, it's kind of trendy for 6 years. And then we looked at the fourth day to see, you know what? It's funny, but the trends continue. The reversals got higher. The magnitude of the change got greater just because, we're deeper into this. The numbers stayed pretty consistent. I mean, each stock is a little bit nuanced, whatever. The numbers stayed pretty consistent throughout. And as you can see here, essentially the same thing, except obviously the magnitude of the change is now, it just goes up exponentially, but the move upward and the reversals are all about the same. Over the past 6 years, an analysis of the average percentage changes in stock prices following earnings announcements reveals 3 key trends: reversals, stability, and upward spikes. Notably, from day 1 to day 5 after an earnings announcement, stock prices tend to rise more often than they reverse, with the average upward movement occurring about 65 to 70% of the time. The data also shows that stock prices have never remained unchanged following an earnings announcement. That's really interesting. They basically, that's more interesting than anything else, is that they never remain unchanged. Additionally, the magnitude of price changes grows over time, indicating that the market activity reevaluates stock values as the days pass. This pattern suggests a dynamic response driven by delayed reactions, new information, speculative trading, and resulting in increased post-earnings volatility, which to me was one of the more First, there's 2 really crazy takeaways from this. One is that we never stay the same, and 2 is things don't get better; they get a little worse as far as the direction goes. From reading this or from watching these numbers, I think taking your stuff off relatively early makes the most sense. Waiting,
and that's the way that we've been doing it with the show, for sure.
I know, and waiting seems to make things worse, not better. It was just interesting to look at the 5 days of data and to look at now again, these are 5 really healthy, the biggest stocks in the world.
Sure.
And we've been in a bull market. So there's a lot of positives to this. But for the last 6 years, it's really interesting information.